This week is dominated by central bank decisions, and whilst we're expecting rate cuts from the BOC and the FOMC, things are a bit different for the other two major central banks. Both the BoJ and the ECB expected to keep rates steady. However, there's different stories behind both of them, and certainly with the Nikkei 225 breaching the 50,000 mark over the course of this week, it's worthwhile looking into these two rate decisions to ascertain exactly what they can mean for their currencies and also their stock markets. Let's kick off with Japan. Notably, of course, we've got a new prime minister in Japan, and the Takeshi trade has led the likes of the Nikkei 225 into the 50,000 mark. Certainly, it's been a rampant rise for equities in Japan. But whilst you're seeing a more expansive outlook in terms of fiscal policy, you're seeing the possibility that we see the BoJ taking the opposite stance with the possibility of rate hikes coming in the near future. Now, why might we see rate hikes or why might we not see rate hikes? One of the possibilities or one of the fears at the BoJ will be the rise in terms of borrowing costs. Now, notably, you can see here the rise of the long-term yields associated with Japan highlight the problems associated with the so-called Takeshi trade or with a more expansive fiscal outlook. Essentially, borrowing more means that people think that the country is more unstable. They demand more to be able to take on their debt, particularly the long-term debt, because over the longer term, it looks even more unstable. And therefore, you're seeing the likes of the 20, the 30 and the 40-year yields in Japan just continue to climb and climb as a result. That's problematic for a country with a huge amount of debt. Now, this is the sort of short to mid-term yields, and you can see not necessarily as dramatic. If you're looking here, we've sort of overcome all the peaks back in 2010. For these, some have, some haven't. It's not necessarily been as steep a rise. In part, this is because we're influenced over the short term to a partial extent, particularly with the short-term yields, like the 2-year to 5-year, more influenced by monetary policy. And as we know, rates at the BoJ are still relatively low, despite the fact that they have raised rates to an extent. They're well behind on that front. And so the question mark is, do we see the BoJ pushing rates higher once again, given the fact that that's likely to ultimately drive yields higher? Now, in terms of the debt to GDP ratio, you can see here with a nice visual. Might need a pause on the video to really take it all in, quite frankly. But if you look at Japan, they are the standouts here in terms of how high the debt to GDP ratio is in Japan, 230%. And so that's why in the past, the Japanese have been a massive buyer of US treasuries, but there's question marks that if we see higher yields, does that flow come back towards domestic bonds? And therefore you have question marks around demand for US treasuries. Nonetheless, for the time being, essentially you've got a country that's massively in debt. They've already got rising bond yields, so borrowing costs are continuing to rise. So that means that the BoJ, if they were to hike rates, it would put further strain on that relationship, pushing up borrowing costs and increasing the debt once again. Now, in terms of inflation, that's part of the story on why they might act, right? Because inflation has been moving higher. This perhaps isn't the clearest, but I'll talk you through it. Essentially, you're looking at the year-on-year headline CPI rate across many of the major economies in the world. The reason I show you it in this format is that if you look at the sort of mid part of this, over the sort of inflationary boom that we saw throughout 2021, 2022, Japan certainly didn't get anywhere near that, right? I mean, it pretty much got into the sort of high 2s and 3s. But whilst we've seen inflation drop for many of these other countries, inflation in Japan actually has remained relatively elevated. You can see it's at 2.9%. That's actually below the likes of the US and the UK, but it's above pretty much the rest of them. Okay, New Zealand at 3%. So half of the countries listed in this slide have inflation rates lower than Japan. So Japanese inflation is elevated. part of the reason why the new Prime Minister's predecessor was booted out is because there's a feeling that the cost of living is getting too high in Japan. Now, that could be a case of needing to raise wages, and wage growth has been pretty healthy. Or drive down inflation. And where you're seeing wage growth and inflation elevated, you might say, okay, they're netting each other out, but that might happen for some. It might not happen for others. It means many people within the country struggle because their wages haven't gone up much, but the cost of living has gone up. So that's why they end up thinking that they're under pressure and they start trying to vote for change. So there is a pressure to try and drive down inflation. In terms of what your everyday person's asked for, well, they've asked for a new leader that isn't necessarily all about cutting costs. So they want someone that's expansionary in terms of stimulus measures and the like to grow the economy, but they also want inflation to be lower. So in a way, it's the role of the BoJ to try and drive down the inflation rate. It's potentially the role of the government with fiscal policy to be able to drive up growth within the country. And that's why you see that potential divergence coming into play here. Notably, whilst we're seeing that 2.85 reading on the headline CPI, you can see it's 2.5 for Tokyo, but crucially, you can see that actually declined whilst we saw a rise. And generally, you do see the two going hand in hand. Generally, Tokyo leads the nationwide figure. So that's notable. Doesn't mean that actually the pop in terms of, I wouldn't say a pop, but the rise recently in terms of nationwide inflation is actually a one-off because it's a divergence from the Tokyo figure and maybe it'll drop next time. Perhaps. But what I wanted to show you this slide for is that in actual fact, where you're looking at inflation, much of it is really just heavily geared towards the back end of last year. So if you look at the month-on-month inflations for October, November, December from last year, you've got the best part of sort of 1.5% to 2% inflation right there, right? 0.6, 0.5, 0.6. So you've got 1.7% of inflation, and then from there onwards, it's been largely controlled over the past, say, 7 months. So if you look at it from a sort of annualized basis, we've got 3-month annualized, 6-month annualized. Inflation, by and large, is under control. And that means that maybe as we move forward, if we don't necessarily see a hike this time, then the pressure on the BoJ might ease significantly over the coming months as inflation drops notably, and therefore we don't necessarily see the BoJ act too swiftly. In terms of why they might need to act in terms of take a more cautious approach and be a more accommodative, you can see in terms of the outlook. This is the outlook for growth from the IMF. Japan, 0.1 growth in 2024, 1.1 expected for this year, and just 0.6 expected for next year. So there's fear around the direction of travel, especially given the trade war. Of course, we have seen some nice news headlines coming out of the meeting between Takashi and Donald Trump this week. So, maybe we see a softening of that breakdown in terms of trade. But certainly this really highlights the difficult task ahead for the BoJ. They don't want to drive up the cost of borrowing. They don't want to hinder growth prospects at a time when they're already not looking great and where you've got a trade war. But at the same time, they do want to drive down inflation. But like I said, there's a good possibility that inflation is going to decline by itself. So if we look in terms of market expectations, you can see the view is we don't see a change this time around. December, markets pricing 56% chance that we pause, so 43% chance of a cut. And the markets are pricing in, a hike. Markets are pricing in a hike for January. That would take us to 0.75. And then from there on in, maybe one more hike towards the back end of next year. But like I said, if inflation comes down in a meaningful manner, which I think it should because of those base effects, it's a good chance in actual fact those rate hikes don't necessarily come to fruition, especially if yields continue to rise. So let's look in terms of a couple of charts that are relevant to this. First and foremost, of course, we've got to start off with the Nikkei 225. Here is the Nikkei 225 over the long term. Here's a weekly time frame. Just shows you what a dramatic run up we've been seeing of late. It's taken out that 50k mark. Essentially, you've got a very strong bull market in play, and you don't necessarily know where it's going to come to an end. And it's not necessarily my job to tell you exactly where that will happen. I think a lot of the time people are always trying to find an exact way to say this is the exact point it's going to stop. But we don't necessarily know, and we don't necessarily know how things are going to develop in terms of trade policy, in terms of monetary policy and the like. And that's why it's just a case in my mind of just noting what levels would be required to start changing your mind. So essentially, I'm just going to be looking for this trend that we're looking at over the near term, which is a 4-hour chart, to continue apace. So essentially, I'm just drawing on fibs, but it's kind of irrelevant right now, right? So that would be more relevant in the more recent pullback. If we come into a pullback here, do we see a breakdown through the prior swing low, which is currently 48442? You can see on the top end, you could be saying this is a rising wedge formation, so it points towards a possibility of a breakdown. Yes, but ultimately, the trend continues to be a bullish one. I think if we break down through your swing lows, then it starts to point towards a wider pullback coming into play. Until that happens, retracements are likely to be brought up once again. And in particular, if we see a BoJ meeting this week where they say, inflation is a bit of a problem at the moment, but if you look at the trend over the course of the past 6 months, we think inflation's under control, and therefore we're data dependent and we think the data is going to turn in our favor, then in actual fact the pricing around those rate hikes might ease somewhat into next year, and that might provide a further leg higher for the Nikkei 225. Now, in terms of dollar yen, it's been gaining ground of late, starting to weaken a little bit here. Now, of course, the weakness of dollar yen would likely come in a view that we're going to see a more hawkish turn from the BoJ. Are we going to see a rate hike this time? Markets think no. Are we going to see a rate hike in the near future? Markets think yes, they think January. But like I said, with the whole inflation picture, maybe we don't see that. Maybe we see a relatively dovish tone from the group, and in which case that could provide another leg higher for dollar yen, which certainly has been playing out at the moment. But if you look at the wider context, it's a case of sort of descending triangle formation that we've got at the moment. So let's just get that up. I'll call it a trend line, but it's only got 2 touches. So unconfirmed trend line. Then you've got at the bottom end the flatlining lows at 140.2. So we're coming into the realms of that resistance level. Do we see it roll over? Well, if we see a sort of hawkish tone taken from the BoJ, then possibly that provides that turn towards the downside around this descending trend line and sort of 76.4 fib around your 154 mark. But yeah, keep an eye out for this. I'm not completely convinced that we are going to see a super hawkish turn from the group. If inflation remains under control, which it appears to be, in my mind, if you just ignore the year-on-year figure and you look at the monthlies, that would point towards them being able to remain accommodative. Of course, central banks don't necessarily want to keep interest rates at rock bottom levels. They want to keep some powder in the tank. That's probably not the phrase, but they want to keep something in the tank to be able to use it if need be down the line. So ideally, they would be able to normalize interest rates, especially now that they have managed to drive up wage growth, which appears to be in a healthy way. So it's been a vicious cycle of a lack of inflation spurring a lack of wage growth. Now we're seeing inflation. We're also seeing wage growth. So if we see high wage growth coming into play, and you could say that inflation wage growth cycle is spinning once again, maybe the Bank of Japan think it's time for them to try and drive up rates into a more normalized level to be able to act down the line if need be. Then let's talk about the ECB, and here we go. This is the outlook in terms of inflation, or the outlook, the current picture in terms of inflation. You can see here CPI, core CPI, both around your sort of 2.3 kind of area. But once again, the evidence here points towards inflation being a big problem. At this time is around February, March, April, and then since then, May, June, July, August, September, all relatively under control when it comes to inflation. So the ECB over the near term don't really have an issue to deal with when it comes to inflation. So does that mean that they're going to cut further? Maybe not necessarily, because they already have cut to a really significant degree. You can see a similar kind of picture here, right? February, March, April, massive inflation on the core numbers. So we're going to see some big disinflation in Q1 coming into Q2. So inflation isn't a problem, but it doesn't mean they're necessarily going to sort of drive down interest rates to zero per se. You can see here in terms of the PMI numbers in the Eurozone, they're relatively healthy. You can see the composite 52.2. Yes, manufacturing is just below that 50 threshold. But by and large, the economy looks all right from this perspective. They've really done a lot to help the economy by way of early rate cuts. Their rates are significantly below the likes of the BOE, for example. And you can see here in terms of market expectations that we aren't expecting too much. You can see in terms of where we might see a rate cut, markets aren't pricing anything. Could that provide the basis for the likes of Christine Lagarde to come out and actually shock markets with an outlook to say that she might act, or the group might act, to ease further? Potentially, but it seems unlikely. It seems like they're done here, and that's why I think it's an interesting one to draw a parallel between the ECB and the Bank of England. And this is why, I've been rabbiting on about this for quite a while. It's one of my favorite charts to show you when I'm talking about the ECB and talking about the Bank of England. The Bank of England are at a turning point, right? They haven't really been able to ease, but inflation has shown itself to be under control, essentially, since that massive figure in April. So that points towards the Bank of England potentially starting to get a move on when it comes to cutting interest rates in a way that they haven't been able to in the past. Whereas the ECB are now pretty much done. So it's that differential between the two that potentially drives this market. So let's see, I don't want to spend ages on this. Euro to yield. There we go. And then GBO2Y. There we go. So this is your relative yields between the two. If you look, there we go. So this is how you can see the sort of relative expectations around rates from the central banks and how that feeds into, say, the 2-year yields, which in the near-term yields are quite closely correlated to both rates at the central banks, but also expectations around that. You can see how that close correlation drives euro sterling. And what's happened of late here is that we've been seeing this rise. We're seeing much more significant swings in the FX pair compared to the moves in terms of the yields, but certainly we're seeing that upward move in terms of yields. That comes from the ECB essentially being done, and now people growing gently confident, increasingly confident that the Bank of England are going to start cutting rates at a more rapid rate soon enough. They're not still super confident because markets are currently pricing. Let me just jump on this behind your back. Markets are currently pricing the Bank of England to cut rates. How regularly? So next rate cut's December. So one rate cut. Then in 2026, you're looking at another one, maybe two. So let's say markets are currently pricing 1, maybe 2 rate cuts from the Bank of England next year. That seems unrealistic if they've got inflation under control. So the point is that number in terms of market expectations is likely to change, and that will really influence this chart here, right, in terms of the rise in terms of the yields. And so that should point towards further upside coming into play for euro sterling. Now, what's notable is that we've, of course, been talking about this trade and talking about these pullbacks into trendline support as being buying opportunities. This is something I've talked about for a bit now because it's been naffing around for a while at trendline support and this 76.4 fib, but now we're on our way. We've broken up through resistance. So played out absolutely perfectly. And in actual fact, sometimes it's better rather than just tag it for a few seconds in a day and then rallying really hard. This gave you a few bites at the cherry, so to speak. We were back around here for quite a while before the bulls came back into play. So I remain bullish for this chart. It remains one of my key ones to be following. Now, other than that, this is the DAX. If we see the ECB sort of holding off, you're sort of losing a little bit of the reasoning behind why people are sort of confident around the Eurozone. Also, we've seen that significant boost for the DAX already around this idea of increased spending on infrastructure, on defence and things like that, right? So it sort of feels like it's floundering a bit. And so firstly, I'll just want to show you, so let's just put sort of S&P 500 onto this. Let's just put it into a different scale so you can see in terms of, I'll tell you what, let's not put it on a different scale. Let's put it on a SPX, that same scale, and I want it on index 200. There you go. So this is what's been happening recently, right? So US markets really gaining traction in a meaningful manner. over and above what we're seeing from the likes of the DAX. Now, let's get rid of that and we'll show you it as a ratio, right? And so what we're seeing here is this significant decline in terms of the relationship between the DAX and on this occasion, the Dow, right? So essentially we saw the whole Donald Trump thing, and the rise here points towards outperformance for German stocks against US markets. But as we were talking through the time, the long-term trend, the long-term trend generally isn't necessarily in favor of European stocks. It's generally in favor of US stocks. And we're now starting to see that coming into play once again, that the US equities are gaining favor over the likes of the DAX. And so you can see as it trends towards US stocks on the rise. So I'd expect more of the same. Essentially, if we're looking at, benefactors of this rate decision, I wouldn't necessarily say it's going to spark a sell-off in terms of the DAX, but it certainly would point towards the DAX potentially lagging US markets further. And that's exactly what we're seeing at the moment as we see this move towards the downside. It highlights the fact that European equities not doing much at the moment, whilst the likes of the DAX and the S&P 500 and the NASDAQ are really doing very well. So yeah, maybe it's just more consolidation in store if we do see the ECB lay out their stall in terms of holding off for longer. I hope that's been useful. Make sure to like, subscribe and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.